The 10-year Treasury is heading to zero. This was actually a pretty good article I want to share with you from advisor perspective. So it's my man Robert Bob Hoopshire, who's the CEO of Advisor Perspective. We got Albert Edwards here. And I'm not familiar with Albert Edwards, but I thought it'd be interesting for you to hear. All right. Investors should embrace for a deflationary shock that will drive the 10-year Treasury yields to zero or below, says this guy. He's a global strategist for Société Générale and is based in London. Actually, a long time ago, Société Générale did a pretty good white paper I read. This is probably 15 years ago. I think they're on the Société Générale are on the globalist spectrum, so to speak, though. But he is known for his Ice Age thesis, which posited that beginning in 1996, the correlation between bond and stock yields would break down, and 10-year bonds would begin to outperform stocks. His template was Japan and his lost decade of growth, which began in 1990. That forecast has been largely accurate, although it was disrupted temporarily by QE. That's not what. I don't get it. I mean, the template with Japan, but that was already 6 years into it. That's okay. I don't get how that's been largely accurate. Has a 10-year bond outperformed stocks? I don't get it. All right, let's keep going. He's optimistic that global economies are going to go through the last act of the Ice Age. One final bust that will take place over the next 3 to 6 months before we transition to what he called the Great Melt. Deflation and a drop of real yields will accompany the final bust. Economic growth has stalled despite a fiscal stimulus of about 3.5% of U.S. gross domestic product. There is substantial unemployment, and the impact of the pandemic is crushing economic activity. That is the underlying cause for the short-term deflationary hit facing the U.S. Outside the U.S., core inflation measures have already collapsed. And the U.S., the core CPI is 1.6. Some analysts say it may pick up, but Edwards disagrees. The signs of inflation, such as a spike in used car prices, are anomalies. Beneath the surface, the U.S. is behaving similarly to that of Europe and Japan. And he talks about this CPI regular rent inflation. Pretty interesting. He posted a chart below on Twitter, which came from Nomura, which is the Japanese company, which I think Richard Koo used to work for, maybe still does. Falling rent prices take a long way to filter through to the CPI, in part because data is sampled only once every 6 months. But rent is a major component of core CPI, representing near 40%. Housing represents nearly 40% of core CPI and has dropped precipitously. And so there's apartment list rent estimates. I'm not sure who LHS is, but you can see what's blue is CPI regular rent right there, or that red. There's blue is way down, but that doesn't have that much of a time frame. Zillow observed rent index is down. Okay. The red is way. Oh yeah, look at that red. Oh, look at that. That red is way down. Reese apartment effective rate. So look at that. That's 2000. Started in 2000 right here. Dropped like crazy. Yeah, that's ugly right there. Oof. And there's Zillow observed rent, which is down. So yeah, rents are dropping across the board. That's nuts. I didn't know that. He predicts that U.S. core. I wonder if that has something to do with you can't kick people out and whatnot. He predicts that U.S. core CPI will go down to zero once the fall in rent prices is reflected in the CPI. Markets are looking ahead to the success of the vaccines into 22 and beyond. Equity prices and the steepening of the yield curve reflect that outlook. If growth over the next few months falters, though, the core CPI could go to zero. Will the markets look like then, though? He doubts that the markets will be that sanguine. Sanguine. A faltering economy and a decline in core inflation consistent with what's happened in Japan and Europe will lead to obliteration of what he calls a cyclical rotation trade. That is a trade based on outperformance of value over growth during the last month or so, following a decade of dominance by growth. That reversal will be accelerated by the extreme level of optimism shared by market participants, which is shown in a number of indicators: flows to equity funds, bull-bear sentiment, put-call ratio. The recovery of value was very much tied to an increase in implied inflation expectations. This is an artificial rise, though. The Fed's QE, especially during April and May, was skewed toward tips to drive inflation expectations upward. This could be also timely for a healthy equity correction, he says. Key aspects of the ice age are deflation, secular stagnation, and the excessive investment over savings, and are coupled with falling equity prices and the outperformance of growth over value. The problem with the deflationary shock is that it also lowers reported economic growth, as does corporate revenue growth. That will be especially harmful to companies with excessive debt load. Yep. Okay, this is what cracks me up. Edwards acknowledged that he missed the effect of the pandemic on tech stocks, which have led stock market performance for most of the year. But he disagrees with Yale economist Robert Shiller, who writes for the Financial Times, when they say that equity valuations and the elevated CAPE ratio are justified by low real yields. I mean, I can't take it. Schiller is writing now that the high CAPE are justified by low bond yields. What the hell? We've been saying that for freaking going almost 15 years now. At least 10 years. Where's my Nobel Prize? As bond yields come down, PEs generally increase. But once yields go below 3% and move towards zero, PE ratios contract. Well, that hasn't happened. That is true outside of Europe, outside of the U.S., especially in Europe, but it's not true in the U.S. because of the FANG bubble, says this guy. If the U.S. faces an economic downturn or another recession, tech earnings, which are pulled forward by the pandemic, will fall sharply while yields are falling. This could be the catalyst that triggers a market correction. Longer term, he thinks there'll be greater monetary and fiscal cooperation, and the U.S. will embrace MMT, modern monetary theory. Man, we're already there. And the monetization of debt. This is the great melt. One sign of this, which has already happened in the UK, is that the governments are directing commercial banks to lend with government guaranteed loans. These loans are off the government's balance sheet, that is, until they fail. And then they're right back on it. It means that governments can create money without relying on the central bank, which is important in the Eurozone. Budget deficits will persist. Yeah, do you think? There will be no fiscal tightening, but there will be a financial repression, and it will benefit cyclical and value stocks, but that won't kick in now. All right. In the near term, the U.S. economy will suffer, especially zombie companies with outside debt loads. Yeah, I 100% agree. I'd never thought about the rent thing. That's interesting. We'll have to keep our eyes on that. I don't know if this guy's right or wrong. I mean, look, man, all these guys freaking, like I said, economists, the whole point of an economist is to make a astrologist look good, but it makes sense. If that rent thing is going to be included in CPI in the next reading, that could be problematic for sure, but I'd like to hear your thoughts. We'll see ya.